Good morning from London. This is Bloomberg Markets Today. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. With the cash trade just an hour away, here's what you need to know. Apple makes its long-awaited AI reveal, including a partnership with ChatGPT and a new artificial intelligence platform. Elon Musk responds by threatening to ban Apple devices from his companies over security fears. Early drafts of the UK Tory's Manifesto failed to impress cabinet members over a perceived lack of big-ticket pledges. We'll look ahead to the launch and break down the latest jobs data from the UK. European futures are higher after a record close from the S&P 500. Attention now turns to the Fed and the beginning of the FOMC's two-day policy meeting.
And perhaps some of that optimism showing up in the markets. You get a quick check on how assets are performing. Eurostoxx 50 futures higher by 0.3%. FTSE 100 higher by 0.2. Eurodollar 107.67. Cable slightly weaker, but nothing to write home about. 127.26 on the pair. Markets today starts right now.
Tuesday, the 11th of June. Good morning, folks. We shift from the politics to the macroeconomic data this morning. That will be the theme over the next couple of days as well. Remember, it is day one of 2 days of the Fed meeting. We get CPI out of the United States as well tomorrow. But our attention turns, first of all, to what is happening here in the UK. Yes, politics, I suspect, will dominate the lunchtime news as we see manifestos being revealed by the Conservative Party. And we've already seen, obviously, the Liberal Democrats. But the data this morning is really what is telling us the story of how the UK economy is. And this is the unemployment data, and it is also the wage data. You need to take a moment to digest what you're seeing here, but the screen tells it all at the moment. The pound is weakening on the back of this data. Broadly, this is less strong data than maybe was anticipated by the market. The average weekly earnings number comes in stronger at 5.9, and the previous number has been revised higher. But elsewhere, actually, the data looks more mixed. Weekly earnings, ex-bonuses, come through at 6%. The market was looking for 6.1. The unemployment rate ticks higher than anticipated to 4.4%. So the data may be a little better for the Bank of England here. Maybe clarity starting to emerge that we are really starting to see the labour market weakening a little bit. But in reality, probably wages are still too strong to deliver an imminent rate cut, Anna.
Yeah, it's possible to take a kind of mixed view of what you've just gone through there, Guy, isn't it? But the market does seem to have concluded that maybe this means we get to those rate cuts a little bit sooner. But the market isn't expecting that to happen very soon, is it? Because,
August,
of course,
September seems to be the kind of
exactly. So later
trade
in the year, because, of course, you said we've moved on from the politics, but it didn't take us long to get back to it. Of course, the election is going to get in the way of many people's thinking about what's happening in the UK and specifically the Bank of England's trajectory from here.
Yeah, I thought it was interesting when we were speaking about some of those manifestos and the expectations around the fact that, at least going into some of the data and into some of this conversation, that it was largely expected that this is a no-brainer, that Labour was going to kind of get the business community's vote. Now this narrative of capital gain seeming to weigh more on people's minds.
So we'll certainly look ahead to that Conservative Party manifesto and what that includes. Tax cuts broadly seems to be the way that they're going. We started this campaign with both parties sort of sticking quite closely together on a number of issues. And now maybe on taxes, the Conservatives are trying to find a dividing line. They tried to suggest that the Labour Party are going to put up taxes. Labour says that's nonsense on certain taxes, well, not all of them perhaps, but the ones that people, average people pay maybe. But now the Conservatives trying to draw that dividing line between, well, they might stand still on tax, but we're planning to cut them.
How will the market react to tax cuts is my question. That's the bit that I think is interesting here.
Post-Liz Truss?
The Liz Truss lesson is that actually the market doesn't respond maybe as positively as you would have first thought. So it'd be interesting to see. Let's kind of hypothetically say the Conservative Party won the general election and cut taxes aggressively. Would you get a positive market reaction? I do question that. And then to Kriti's point about capital gains tax, this seems to be the debate this morning. The Labour Party is not ruling it out, a significant increase in capital gains tax. They've changed policy on the pensions. They've changed policy on other tax areas as well. It seems that their approach to taxes, we've got to tax something, but we can't quite figure out what it's going to be yet.
We talked to the Labour Party very recently, didn't we? And we asked, are you going to put up any taxes? This was weeks ago, and their line then, and this has at least remained consistent, was that they weren't going to put up taxes on the things that average, everyday people pay. Now, you can define that, of course, how you like, but that was the line that they were talking about. And so the focus, therefore, goes to capital gains tax, goes to all the areas that companies might be interested in, and private equity, for example.
Yeah, it is. It's a fascinating one, especially because this is always a conversation at Super Return, of course, whether or not this was something that would disincentivize some of that money going into the alternative space. There was an interesting analysis in the FT this morning that said that actually maybe this is entirely designed to reduce the incentive to move income into your capital gains and reduce that tax liability. And this is a way of doing that. I thought, on the other hand, to go to Guy's point, especially about whether or not the markets would react to it, my favorite phrase of this week is debt sustainability and how people can handle their public finances, whether it's the UK, whether it's France, whether it's the United States. And it feels like the sensitivity to that is growing in the bond market.
And not just on the bond market. I'm really interested in how risk assets broadly respond to majorities and to mandates, because we are in a year where politics and markets are going to come into conflict or at least rub up against each other. You know, in some geographies, the logic used to run, if you kind of got paralysis, that was good for markets, because markets didn't necessarily want governments to do all that much. But now you're in a situation where I'm reading various comments saying, actually, if the Labour Party, for example, if polls come true, in the UK get a big mandate, that could be good for risk assets. So, you know, there's a complex conversation. I thought Ewan Munro is coming up later in the programme from Newton. We can get his take on the links between politics and markets.
I don't know yet. It's going to be interesting. I think, yes, a big majority, but you then get to do what you want, and maybe actually...
But you're less beholden to the wings of your party is the counter-argument. But yes, absolutely, I understand.
But it means basically you have a free hand to raise taxes and pursue a more interventionist... I don't know is the honest answer, and I don't think the market really does either. I love these kinds of speculative, the markets will take it as positive. Really, I'm going to wait and see what the market actually does when we actually see the results and figure out exactly where we go from there. I still remember the night when Donald Trump was elected, standing there watching the markets. The anticipation was that it would be hugely negative. Within a couple of hours, it was hugely positive. We will, I suspect, probably learn.
Yes. And we'll keep collecting views, won't we, on this programme as we head towards the the vote. Let's pivot our focus to Apple, other big story overnight, revealing their hand, playing their card when it comes to AI, perhaps a little bit late. I liked some of our Bloomberg colleagues writing, this was an understated approach to AI, and the market seemed a little underwhelmed, understated.
The market reaction was pretty clear. Stock went down. This is not the big kind of sort of shift in AI that the market was hoping for. I don't know. Apple has a history of taking what somebody else has done, perfecting it, making it better, and moving on and selling a lot of it. And was that what we saw yesterday? I wonder.
Well, this partnership with OpenAI in particular caught a little bit of ire. Not only is Apple seen as being late to the game, we've talked about this ahead of every NVIDIA conversation, really, which we should mention as well. NVIDIA is now a bigger component of the S&P 500 than Apple was.
It's amazing, isn't it?
It's fascinating because I think it's now at 5.2%. Apple at something like just shy of 5%. The fact that Elon Musk came out and said, we're going to basically ban Apple products if this indeed comes true, because it's a security risk, is enormous. I think the context is important here because he, along with Sam Altman, were one of the kind of founders of OpenAI and have both been very vocal about the risks associated.
But now they don't like each other very much, seems to be the message. And is this about...
The bromance broke up.
Is this about Elon Musk's view of the security risks or Elon Musk's view of Sam Altman?
So you want to delve into some of that detail, and I'll wait to get more from our colleagues on that front. Some of the things that this technology will allow us to do, though, team: summarise text, that sounds useful; create original images, access via Siri; sort through your emails. Anybody who can help me prioritise emails is winning in my books. But the stock market reaction, you're right, was pretty well, I don't know, not conclusive actually. I mean, down 2%. You know, it was negative. It wasn't
2% for Apple is a lot of money.
It's a lot of money. It's a lot of money. Dave Lee writing an interesting opinion piece, though, saying that Cook is ultimately, no matter how late to the game Apple is, Cook is ultimately the kingmaker here, because, you know, getting AI to work on all of those Apple devices globally is going to be the thing that matters. And testament to that, we also saw the Alphabet share price rise, and that was because they referenced partnering with others as well as OpenAI.
Yeah, and we should mention this OpenAI story. It's feeding back into Microsoft as well. I talked about how NVIDIA is now a bigger part of the weighting relative to Apple. It's still beaten by Microsoft, a 7% weighting in the S&P 500. Remember, they have a 49% stake in OpenAI. So this is really this one company kind of feeding into so many of the big tech companies.
Let's talk about what we've got for the rest of the day. We know it's the Fed day one. Fed Day 2 tomorrow, obviously probably more significant. 5 p.m. UK time, we get a 10-year auction. There's a recovery conference surrounding Ukraine today. We'll keep an eye on what's happening there. We might be doing some live pictures. OPEC monthly oil report coming out. Aftermarket earnings, Oracle, And we've got a bunch of ECB policymakers speaking at various events. Lagarde, I thought, was quite interesting yesterday in terms of talking about this kind of non-linear approach that they're taking to when the next rate cut ultimately comes. July increasingly feels like it's not an option.
Yes, maybe not. Maybe things not so linear, as she said. We'll put the quote on the screen, but not necessarily rates declining in a linear path. We may need to hold again. And I thought it was interesting that this was not just to one paper in Europe, but this was widely published in a number of papers across Europe, as if this is a concerted push to communicate something to financial markets and to people and their expectations about rates.
You know what I thought was so fascinating here is that they're not actually saying anything that isn't kind of in your economics textbooks here. They're not saying that the idea of one cut is followed by another cut. It's actually meant to be kind of a you decide as you go type of thing.
All our memory is of crisis, isn't it? All our rate-cutting experience in the last so many decades is of crisis.
I do remember, though, the ECB kind of switching rates and then having to switch in the opposite direction fairly quickly.
Yeah.
So at what point does this June cut start to look isolated? Is it September? Is it kind of December? I don't know.
But what I'll say to that, and maybe I'm the contrarian here, is why is that a bad thing? And this is getting back to the economic story, right? That cuts aren't always, to your point, an indicator of crisis is on the horizon. Sometimes it's just a matter of kind of finding the right balance, right?
Yeah. And I mean, I'm sure we'll get into conversations in the weeks and months to come around, defining policy mistake. What does policy mistake look like? And we'll have plenty of time to throw that one around.
I think if the next move's a hike, this was a policy mistake.
Is that as simple as it gets?
Yep.
What about if there's a long lead time? I don't know. I'm not challenging, just asking the question.
How do you trade a policy mistake in the making? I don't know. Isn't that the lesson of the last couple of years, around the Fed at least? Everyone's saying that this is going to be, this transitory conversation, et cetera, and no one quite knows what that actually looks like.
Coming up on the programme. Let's get to that. Coming up on the show,
Anna doesn't have a response.
One of the largest market makers is entering the European rates market. We'll speak exclusively with the global head of rates trading at Citadel Securities. Michael DePass joins us. That is at 8:30 UK time. Plus, a deeper dive into Apple AI's unveiling and what it could mean for the future of tech. Up next, though, back to the big market moving stories, including the coming FOMC decision. It's day one today. Of course, as Guy says, the decision comes tomorrow. If you have any questions for our guests, please do get in touch. IB plus BBTV Go. That is the function to use on the Bloomberg terminal if you want to get in touch with the team that makes this programme. This is Bloomberg.
Wednesday, the Fed decides.
What data is important?
What would it take to reintroduce the rate cut conversation?
It's the labor market cracking that's going to allow the Fed to really enact some of its easing.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Inflation is still too high, and the path forward is uncertain.
They believe that policy is sufficiently restrictive.
The Fed can only deal with the data that it has.
Bloomberg surveillance, the Fed decides, starting at 1:30 p.m. Eastern.
Tuesday the 11th, good morning. 44 minutes until equity markets open here in Europe. Expectations maybe that we get a little bit of a bounce this morning, but let's not get overly excited. We've got a lot of big events coming up over the next few hours that are likely maybe to determine the sense of direction that we have for the rest of the week. I think probably the story over the last 24 hours has been that politics once again has injected itself into equity markets, global bond markets, in a way that very few people have anticipated. We've been very focused on what has been happening with the story surrounding rates, the ECB, the Bank of England, and, of course, the Fed. Are we underestimating what impact politics can still have this year? Wei Li, BlackRock Global Chief Investment Strategist, joining us now to discuss all of this. Wei Li, good morning. Great to have you on the programme, as ever. We're all getting pretty comfortable with the will they, won't they argument around central banks. The focus obviously now turns to the Fed, but it seems that politics is inserting itself in a big way into markets. It was the French decision yesterday, the Emmanuel Macron decision to call a snap election that sent global markets into a little bit of a tizzy yesterday, but we're really building up to November as the main event. Everybody's watching that so carefully. Before that, we get a French election, we get a UK election. How are you thinking about politics and the way that politics could impact the way that investments turn out this year?
That's a great question. When we think about the impact of politics, we think about what it means for policies. So specifically about the US election, we're thinking about what the different outcomes can impact, for example, the fiscal trajectory, the immigration policies, as well as the energy transition. There are some common themes, no matter what's the outcome. So, for example, in terms of the fiscal trajectory, no matter who gets into the White House, we see fiscal trajectory kind of heading higher, the level of indebtedness increasing, given the various kind of spending being talked about by the candidates, which is why we are more cautious around long-term government bonds, because we see potential for U.S. term premium to reflect the higher level of indebtedness and fiscal uncertainty. Now, having said that, we think that equities are a good way to kind of think about capitalizing on mega forces such as AI, which is why we prefer equities over bonds at this juncture as we think about the U.S. equity market.
The AI argument, the AI story seems like it's in its own little world right now. Elsewhere, though, I'm wondering how I think about hedging the political risk that I'm now facing in my portfolio. Traditionally, you'd say, I'm sure the answer is a diversified portfolio, have a mix of assets, and therefore I'm going to likely be able to see some of them outperforming and some of them underperforming. The problem with that is that we are seeing diversified portfolios underperforming right now. So given that underperformance, what do I do? How do I hedge political risk at the moment?
Guy, with regards to diversification, I would say two things, right? So we're talking about very concentrated market themes. What is diversification in the face of really meaningful transformations, right? Like, why would you want to diversify away from your concentrated bets that so far have done very well? I'm looking at the Magnificent Seven. So that's one observation I would make. The other observation is that when it comes to diversification, what we have noted is that the traditional diversifiers of the past, such as long duration, have not been as effective as diversifiers for portfolios, given the broadly still inflationary environment because of the structural forces, right? So you look at some of the geopolitical episodes so far this year because of the read across to oil and read across to inflation. Actually, duration hasn't done very well. So I would think of diversification as more about taking deliberate risks, being very deliberate about putting cash to work, putting your risk budget to work, to convictions that you have around kind of longer term structural themes that have a longer runway to play out, rather than the traditional risk model, because the relationships may not hold in the new environment. I would also note that commodities, energy, gold have been better diversifiers than long duration so far this year.
Wei, you talk about the long duration kind of lack of hedging ability there, and I'm curious what the case is for long duration in the face of some of the debt pressures that you're seeing on both sides of the Atlantic when it comes to public finances. What do you do with that? How do you trade that?
Well, currently we have a preference when it comes to the government bond market. We have a preference for European government bonds and UK government bonds over US treasuries more broadly, given market pricing. But in terms of where we prefer along the shape of the curve, we like front end and the belly of the curve rather than the long end of the curve, precisely because of what you talked about, that we see the fiscal trajectory, high level of indebtedness actually making the current level of term premium, which is still very, very muted, not sustainable, especially over a longer term. Now, having said that, income has returned, and we do find income in fixed income a more attractive source of kind of quality income in portfolios. But where we get that income matters in the context of the fiscal dynamics and the issuance dynamics that is coming up, that has been driving the relative performance as well.
But wait, isn't that quite contrarian relative to the fact that in an election year, specifically in the States, with tariff risk, with even 2 wars raging in this region alone, isn't there a risk of capital flows going straight into American assets by the end of the year? wouldn't that undermine the case for European debt?
I think if you look at actually the trajectory, fiscal trajectory between Europe and US, there has been a bit of a decoupling. Yes, France has been recently downgraded, but more broadly, a European kind of direction of travel is a little bit more prudent compared with kind of the US direction of travel, almost regardless of who gets into the White House. We're more talking about where the money gets spent rather than if the money gets spent. So that's one consideration that is very important as we think about kind of the election landscape for the rest of the year. The other thing I would say is that, yes, capital can be drawn to US market, US capital markets in the context of search for safer assets in the context of broadly unstable geopolitical environment. But US equity market has been a almost more appealing place to draw such capital inflows so far, but also as we look ahead, right? So like you look at US equity market, it's not just the AI theme. We're talking about 7 out of the 11 sectors actually growing their margins. We see this theme spilling over and broadening out, benefiting sectors that are a bit further downstream in terms of the AI play, and we do think that there are more kind of ways to play it at this juncture.
Okay, so other opportunities in AI. Good morning to you, Wei Li. Let me ask you about the near-term market story and risks for risk assets around all the events of tomorrow. We have inflation data out of the US, and then we have an FOMC meeting that produces new dots. What's your broad expectation of how tomorrow plays out?
So we're currently in a very unusual rate cut cycle. The ECB has gone before the Fed, and rate cuts are being talked about when inflations are still way above target, and also growth is not really that dire. We're not in a recession, right? So this is highly unusual. So specifically, as we head into the Fed discussion this next 2 days, I am looking for them to adjust the dot plot to reflect less cuts for this year, maybe 2 cuts instead of 3, maybe even 1 cut. But also, if you think about the previous FOMC, they took out 1 cut for 2025 and also 2026, right? So really kind of acknowledging that maybe neutral rate has risen. So I'm also looking to see that if they continue to kind of keep the door open for possibility of neutral rate haven't risen by kind of adjusting the longer term rate forecast as well. High for longer is indeed what we're dealing with and is indeed here.
And do you think stocks continue to remain resilient as we continue to price out rate cuts?
I think at this current juncture, given how strong earnings have been and also how strong momentum is, especially in the US equity market, if we take out 1 cut for this year, I mean, we're just really just catching up with market pricing. If the dot plots take out 1 cut for this year, I think equity market can take it because we're really focusing on the earnings, the growth piece, G rather than R, the rate piece in terms of what's been driving equities so far this year.
Okay, so we focus on the G and not the R. Wei Li, thank you very much. Thanks for joining us. Wei Li, BlackRock Global Chief Investment Strategist, with us this morning to talk about the interaction between politics and economics, and, of course, to look ahead to the FOMC decision, which we have coming up this week. Coming up, we'll be back to what politics is doing to markets. We'll be diving deeper into that UK data we had at the top of the hour. We saw some movement on cable as a result, the UK wage data, and, of course, the politics in focus for us as that snap election looms. July the 4th is the date for that. Today is the date where we get more details on the Conservative Party manifesto. We'll look for their commitments. How are they going to pay for any tax cuts is crucial. This is Bloomberg.
Minutes to go until the start of equity trading here in Europe. What do you need to know? You need to know that equity market's probably going to be on the front foot this morning, but we're kind of post the politics, pre the kind of the big macro kind of news of the week. We got a little bit out of the UK this morning, and we are obviously building up to the Fed. I think that's probably going to be the main event. So today feels like potentially a little bit of a hiatus in terms of kind of market activity. We'll see.
Yeah, can we rerun this conversation tomorrow in the run-up to the Fed's decision? Maybe we'll do that. Maybe
we could just replay the show.
Yeah, let's do that. Everyone gets a lie in. Let's get to the UK data, though. This is new, and this is what we're dealing with this morning. UK February to April wages, excluding bonuses, rising by 6% year-on-year. The estimate was for an increase of 6.1%. Now, these numbers are not hugely different, but everyone's looking for any cracks in various parts of the UK economy right now. Politicians, of course, looking for signs of sunshine. But what we have right now is a wages figure that's running ahead of inflation, but not quite jumping as much as some had anticipated. Maybe you could say some had feared. If you're over at the Bank of England, they don't want to see wages taking off in any great sense. Let's get some analysis now. First, we'll speak to our UK correspondent, Lizzie Burden, who joins us now on the data and also some of the politics this morning. Give us your thoughts on the data then, Lizzie.
Well, Anna, I'd say that this was a sign of relief for the Bank of England. You've got signs of cooling in the labour market there. If we run through those numbers, wage growth slightly lower than expected at 6%. Zoom in on the private wage growth. That's what the Bank of England's really interested in. That cooled to 5.8%, which is the lowest since mid-2022. Unemployment slightly higher than expected, which, of course, is good news for the Bank of England. That was the highest since 2021. So in terms of where it leaves the Bank of England, we already knew that June was off the table because of the election on July the 4th. But our economists saw August, markets fully pricing November. The pound's dropped slightly off this data. As I say, I'd say this is relief to the Bank of England, and that explains, hence, the market move. It's also a bit of a relief to the Prime Minister, as you say, recovering real wages and rate cuts seemingly on the way.
And Lizzie, we're expecting the Conservative manifesto later. What details might that reveal?
Well, Kriti, every time I come on the programme, I say that this is Rishi Sunak's last chance to close that poll gap with the Labour Party. He doesn't seem to be able to be doing that. He's also got to fend off the threat now from Reform on the right. Of course, this party led by Nigel Farage, who was responsible for the downfall of two of his predecessors, David Cameron and Theresa May. The manifesto is expected to include tax cuts, but it's been drafted by a closed circle of Sunak's top aides. And the complaint outside that circle is that he's not going far enough, for example, with a cut on inheritance tax. We are expecting a further third cut to national insurance, but as one Tory aide put it, to paraphrase, to cut it for a third time when it's barely moved the dial the other two times seems like the definition of insanity.
Got a little orange book from the Liberal Democrats yesterday. It was the back end that actually caught my eye, talking about a long-term objective still to rejoin the EU. I'm wondering why that wasn't further forward, but it does seem it was buried at the back. What do we learn in that Liberal Democrat manifesto in terms of what it would do were it to outperform current expectations, Lizzie?
Yeah, they also want to raise taxes both for frequent flyers in business class, but also for the richest in society, on top of, as you say, that pledge to rejoin the EU's single market, which, of course, they argue would boost trade and growth. Look, no one's expecting the Lib Dem leader, Ed Davey, to be the man in number 10 Downing Street after this election. They're polling fourth at the moment, even behind Reform. But if they have a big surprise, good performance on the night, that could influence the shape of the next government, as it did in 2010 and 2017.
Yep. It would be a surprise, but we've seen in the past that polls can be wrong. So we'll wait and see exactly what the result is the following morning. Lizzie, thank you very much indeed for setting it all up for us and running us through what we should expect a little later today. Let's carry on the conversation. Dan Hansen, Chief UK economist. It's been a long few weeks at Bloomberg Economics, joins us now. Dan, morning.
Morning.
Private sector payrolls. What number do we need to see to be consistent with a 2% inflation target? Because it feels we're miles off at the moment.
It is miles. It's double.
Yeah.
We're basically double at the moment. So I didn't hear what Lizzie said there because I haven't got an earpiece. So hopefully I won't repeat what she said.
Apologies for that, Dan.
That's OK. So we're at 5.8. Inflation in consistent level is 3. Right. So we've got a long way to go. I mean, I think if I was the bank and I looked at this, I would be relatively pleased, because what we had in April was this national living wage rise, and that was and that was like the big risk around this release, and huge amount of uncertainty. And we've already had April's CPI, and we saw what happened with services. It was pretty strong. So I'd look at this and think we've sort of got past this one. The trend is still down. And if you look, I think the thing, if you look ahead, forward-looking indicators are looking pretty positive now on pay. And I think a broader point this is maybe one for us all to think about, is setting pay increases in the context of 2% inflation or 2-ish% inflation. Wage bargaining in that context is very different to 11% inflation. So I think going into the second half of the year, there are some reasons to think that pay growth will continue to ease. It's just an extremely slow grind. And as you say, Guy, the first point you've made is absolutely right. We're still double the level that's consistent with the inflation target.
Yeah, Lizzie was saying that she thought that this would be kind of reassuring to the Bank of England on terms of pay. So does that mean we've passed the risk point in terms of pay because of that impact in the April number of the minimum wage? Because it isn't just at the lower pay scales. I was talking to a UK CEO, FTSE 100 CEO recently, who was saying that it isn't just at that level that this influences. It's because then other pay grades above the minimum wage start to ask for the gaps to be maintained.
Yeah, exactly.
And it can have a bigger impact. So are we through that risk?
It feels a little bit like that. This was the big risk in the pay numbers this year. And you're absolutely right. It's not about the minimum wage itself or the living wage. It's about the differentials and how much they're maintained. Earlier in the year as well, I think we had a lot of firms bringing forward the minimum wage increase. So it came into effect in April, but some firms brought it forward. So the first 3 months of the year have been pretty strong. If you look on a month-on-month basis, it's been coming through. I think, as I say, and as Lizzie clearly has said there, there will be a bit of a sigh of relief over on Threadneedle Street about this, that it hasn't been quite as bad, certainly as it was last year. And I think in the second half of this year it will continue to grind lower, but it's going to be a slow process.
Dan, this morning, capital gains tax, the phrase seems to come up quite a bit. Walk us through the economics of that. If you're equalizing or potentially equalizing the capital gains tax and the income tax rate, what does that do?
Well, I think the thing to look, this is something that obviously the Liberal Democrats are looking at. I think it's interesting. It's always been one of these points in the UK tax system, the consistency of the UK tax system, about why should I be taxed more on my income relative to my capital gains. I think it's an interesting policy. I think it's something that, for the next government, it's something that they could well look at, because what we've got here, of course, is all the main political parties ruling out national insurance rises, income tax rises, VAT increases. And we know there's a fiscal hole. None of the parties are talking about it. So the question is, where's the money going to be coming from? And I think maybe capital gains tax is one of the things. I think the other thing to look at, of course, is council tax. But there's a very small tax base that the UK political party, or whoever comes to power, is going to have to find money on if they're going to keep their election pledges or election pledge of not raising income tax, national insurance and VAT.
A guy was making this point at the top of the programme, and I think it's an interesting one, about risks in promising to cut taxes. And we're going to see some of that, according to all of our reporting and that of others, that we're going to get some promises to cut taxes. They might be kind of aspirational from the Tory party. But we have memories now of what happened when a Liz Truss-led Conservative Party promised to cut taxes and they weren't deemed to be well-funded enough by the markets. Do we run that kind of risk with a manifesto launch?
I think the thing that markets will sort of take solace in is the fact that Labour are 20 points ahead in the polls. So if the Tories come out with this it doesn't look like they will, but say they do come out with a very bold manifesto, I'm not sure it's going to create, obviously, a Liz Truss-style market reaction. The thing that the Tories will do, of course, is say they're going to cut spending in other places. So over the weekend we got £12 billion off the welfare bill. A lot of that has actually already been recorded in the OBR's forecast, so it's not a new saving. But I think the thing that they'll do, and this is what they've been doing in the past two fiscal events, so in the budget and in the autumn statement, they've been cutting taxes predicated on these future spending cuts that look very, very suspicious. And all of that delivers this forecast for debt falling, but it's not particularly credible. But markets appear to be giving the Tories the benefit of the doubt, at least for now.
All right, Dan Hansen, Chief UK Economist over at Bloomberg Economics. We thank you so much for breaking that down for us. We go, of course, from the UK to broader Europe. After Ursula von der Leyen's party won the most seats in the EU elections, she'll be looking to clinch a second term as European Commission President as EU leaders look to resolve top job talks as soon as possible. All over the stories, Bloomberg's Oliver Crook joining us from Berlin this morning. Ollie, EU Parliament, we've got the votes. What comes next?
Right, exactly. So what's happening right now, probably as we speak, are these negotiations of all of these parties that were elected to Parliament. Which bloc within the European Parliament will they sit in? And some of them are well established, some of them we don't know. And probably principally one of the parties that has been a big fascination of this election campaign, which is the AfD, the Alternative for Deutschland, which got 15 seats in the Parliament, substantial vote. Remember, they were ejected from the ID group because of comments made by Maximilian Krah, one of the leaders of that party, saying that basically not all members of the SS were criminals. He has since been ejected from the AfD, meaning that they're really trying to clean up the party to get them in sort of shape to join one of these blocs within the EU Parliament. What comes next is the leaders on Monday, so just a few days from now, will begin to discuss the sort of commission job and all of the other sort of commissioner jobs as well. What is interesting from the outcome of this is obviously the EPP and Ursula von der Leyen are in a very powerful position. You have people like Macron who are causing a bit of trouble, throwing Mario Draghi's name in as a possible name for the Commission president, probably not feeling quite as emboldened as he was before the election. And of course, the last point, which is that the person with the sort of strongest national mandate out of this election is Giorgia Meloni, which throws a sort of interesting curveball into the mix.
Ollie, the real shock out of this weekend's elections came in France and in Germany. So you've already alluded to the fact that Emmanuel Macron, who is now facing an election, parliamentary election, is maybe not as emboldened as he once was. How does the national story play into the debate around who will ultimately be the next president? And given the fact we don't yet know what the result of that French parliamentary election is going to be, how much authority does Macron have here?
Well, I think it's a very interesting question, Guy, and I think that sometimes we sort of underplay the actual importance of the national leaders within the EU. Yes, the MEPs are important. Yes, the commissions are important. But as you remember, Guy, as you've covered many crises in Europe, every time there's a crisis and something substantial happens, it is down to the national leadership and agreements between powerful, strong leaders in their own nations that can make these things and force things through to change. If that is not the case, as is not the case with the two strongest sort of countries of Europe, both Germany and France, that makes things a lot more complicated. As far as Macron goes, I mean, this is a really wild gamble. I mean, you look at some snap polling that was done overnight about kind of where the people would vote in terms of the legislative election. We saw that the National Front, or I should say the Rassemblement National, as they have been renamed, got 32% of the vote. That is more than twice the representation they currently have in the parliament. So for Macron, who's saying, hey, you want a far-right government, prove it, this is sort of potentially a sort of misfire in terms of the gamble. And there are some that are saying that, yes, okay, they're going to be not willing to elect people on the national level that they're willing to elect at the EU level. There's been a sort of historic reticence and a sort of a block in France against the National Front historically. But really, that's reliant on those sort of assumptions at a time when we have seen in Europe a willingness to go further right than usual. And also, let's not forget, legislative elections seen as slightly lower stakes, maybe more willingness to take that risk. And then if they do get into government, more comfort with them there. That is all ahead of the presidential election in France in 2027.
I wonder whether the parliamentary elections fit somewhere between EU elections and presidential elections, and as you say, maybe the population may be willing to take a little bit more risk. Therefore, we could be heading for a 28-year-old prime minister in France. We've already got a young prime minister in France. We could be heading for another one. Ollie, great stuff. Thank you very much indeed. Ollie Crook joining us out of Berlin. Coming up, we're going to take a look at some of the stocks that we need to be watching. Keep a firm eye this morning on Atos, the heavily indebted French IT company, picking a takeover offer made by its biggest shareholder. Got the details of that and what else we're going to be watching. That's as we count you down to the market open. It's 15 minutes away. This is Bloomberg.
Welcome back to Markets Today. We are 13 minutes away from the start of cash equities trading. The futures picture suggests a little bounce at the start of trade, but bear in mind we underperformed here in Europe yesterday, so we're just kind of catching up a little bit with the US. US futures look a whole lot more undecided this hour, pretty flat, in fact, on E-minis and Nasdaq futures. Joining us to talk about markets in a couple of minutes, Bloomberg's Rachel Evans with details on what we're looking ahead to. Rachel, good to speak to you this morning. Let's go first to the risks in markets around two events tomorrow, CPI and the FOMC. A lot of people trying to take account of this risk in the options market. What are we seeing?
Yeah, I mean, this is obviously the time that everyone comes out with their prognostications about how to actually trade these two big events tomorrow. The couple of things that have caught my eye, we're seeing kind of Deutsche Bank recommending looking at tips. They're suggesting going short tips, that's Treasury inflation protected securities, versus nominal treasuries. And the reason that they're recommending that trade is that they've noticed that in the day running up to CPI prints, over the last 27 of those prints, which is since the Fed started raising rates, inflation-protected securities have actually underperformed for 22 of those sessions. So they're seeing kind of an opportunity to short tips heading into CPI on the expectation that that trend will continue. Looking on the stock side, though, we're seeing JP Morgan expecting basically volatility. And they're saying our base case is that we could see a 1.3 to 1.4% swing in either direction around CPI. But that could get as much as 2.5% if we see a significant beat or a significant miss.
Yeah.
We're expecting to see 0.3% month on month for core inflation tomorrow. So that's really the figure to kind of watch out for. And if we see significantly below that, we could see some pretty chunky losses.
We spoke to Whaley from BlackRock earlier, and she was talking about the relative merits of European government bonds versus treasuries. This seems to be something of a theme that's building after the sell-off of yesterday.
Yeah, and I think that's exactly it, right? It depends on your entry point. Like, European bonds may not look fantastic right now, but given where they are versus treasuries, they're at the highest yield. So that attractive yield differential has really kind of like grown over the last kind of few days. So now could be a good time to buy, but it really depends on your spots. Obviously, French bonds we saw sell off significantly yesterday, but there are some bigger issues to worry about with France. There are real fiscal concerns there. So some investors, particularly on the European side, are looking more at countries like Spain, for example, where you have much better fundamentals, or they're keeping it conservative and they're thinking more about German bunds, where they can really see some value.
OK, we're certainly keeping an eye this morning on a fairly muted or more muted response in government bond markets in Europe. Thank you very much, Rachel. Bloomberg's Rachel Evans joining us this morning on the markets. Guy.
Let's talk about what we see in single stocks. There's kind of one stock story that really stands out, and that's Atos this morning. Let's go to Joe Easton. Let's start there, Joe. What do you got?
Morning, guys. So we are starting with Atos, as you say, a potential resolution for the fallen giant of French software. They have chosen a takeover by a company called OnePoint. This is another software firm that is their largest shareholder. They've picked that company's bid over a rival offer from Daniel Kretinsky, the Czech billionaire who we know from his attempts to buy Royal Mail. Now, One Group is offering 250 million euros of equity and also converting 2.9 billion euros of debt into shares as part of that rescue deal. Now, accounting scandals and huge debt has left Atos on the brink of bankruptcy, so this is going to be taken positively, potentially, by the market. There's the one-year drop. Eye-watering declines, down 92% for Atos. But if we flip over to a five-year chart, it's even worse. It gets even more painful for investors. Previously trading at around 80 euros back in 2019. It's now trading at about €1. That's it for Atos. Potentially, though, this resolution is going to be favourable for investors. We're also staying in France to look at French banks following that rout in the sector yesterday. Now, analysts mostly saying that was due to top-down macro concerns rather than any specific potential impact on French banking policy coming in following those legislative elections that were called. Here's the big drops that we saw yesterday. BNP Paribas down almost 5%, Credit Ag down 3.6%, and the big one down the bottom there, Soc Gen fell 7.5% on the day. Now, there's a good quote out from Morgan Stanley today. They say, while from a fundamental point of view, the sell-off looks overdone to us, we think French banks could continue to be weak until we know the result of the election. So they reckon there won't be any big recovery for those stocks anytime soon. But given the little rebound we're seeing in the French futures this morning, we may well see a bit of a pairing of some of those losses today. Then in terms of utilities, we're looking at Naturgy. Now, this is a massive Spanish utility firm, and a takeover for them has collapsed. Takar and Criteria, this is an Abu Dhabi-based company and also a Spanish rival, were in talks to buy the company, but they've backed away from that now. They say the talks haven't come to a resolution. Now, Criteria said in April that it was actually in talks with the Abu Dhabi investor to do this deal, but it hasn't come to the forefront. Now, Criteria does reiterate its commitment as a long-term investor. As a side note, they still do have a decent chunk of those shares. Here's the stock on a one-year chart. Now, this recovery in the shares was after this deal was announced in April. So potentially, given that has now collapsed, as I say, we might see a bit of a pairing in Natg. Keep an eye on that one over in Madrid this morning.
Joe, thank you very much indeed. Lots to keep an eye on this morning from a single stock story point of view. Broadly, though, I'm not sure equity markets are going to do very much. We're waiting now for the next big set-piece event, and that, of course, is, well, there's two, to be honest. There's CPI and there's the Fed decision tomorrow. I think we're kind of conflating both of those two into one event. Note out from Beata Manthi over at Citi that really catches my eye this morning. We introduce our mid-25 stock 600 price target, 580. That's an 11% upside from here. So she certainly thinks, the Citi team certainly thinks, that we've still got further to run when it comes to the stock story here in Europe. It's really fascinating to see kind of where the momentum would come from there, because over in the States, it's all tech-driven.
Right, yeah, and even though we mentioned Wei Li's comments about preferring Europe over the US in terms of government debt, she was broadly more in favour of equities, wasn't she, in terms of asset classes? So she's also seeing something more to play for in terms of the stock story, and again, coming back to the earnings story and to AI.
Yeah, and I'm curious what that does in terms of, like, what is the fundamental besides that? In AI, it feels like there's a short squeeze story. It's not all fundamentally driven. There's a liquidity story there, given all the tech money is coming from the hyperscalers, Apple, NVIDIA, or Apple, excuse me, Amazon, Microsoft, et cetera. But in Europe, a lot of it is the catch-up trade, right? It's the catch-up trade to the U.S. It's a U.S. consumer that's driving it. It's even some optimism around China as well. So that's going to be something we monitor and see if it sticks.
Citi likes tech, industrials and healthcare, i.e. growth, is still the narrative over here. Cautious utilities, telcos, autos. The car sector is having a tough time of things at the moment. Anyway, the market open is almost upon us. We've got around 5 minutes to go until we open for business here in Europe when it comes to the equity side of things. This is what we look like right now. A modest open this Tuesday morning. This is Bloomberg.
Welcome back to Markets Today. A few minutes to go until the start of cash equity trading. You are seeing futures indicated a little bit higher. It kind of feels like this is just a little bit of a reaction to yesterday, where we did see that sell-off, a lot of that concentrated in the French index, of course. But I'm curious to see where some of that love is distributed. Is that to the heavyweights? Is that are we just going back to kind of that safety trade of the sensational six?
Yeah, we were hearing from Joe Easton earlier some market views about whether we recoup some of the losses of yesterday. Didn't seem like it from some of the people he's been talking to. But banks sold off, of course, some consumer products, those heavyweight luxury names sold off in France really strongly yesterday. Maybe they stay there, maybe they stay down, or maybe we see a little bit of a bounce today. I'm
struggling to apply a narrative to today. It's always nice to apply a narrative to a session and say this is going to happen because of this. I struggle today.
Fight your journalistic instincts, guy. Yeah, no, I completely agree. And I think when you brought up the price target coming out of Citi as well, I'm curious, again, where that shows up here, especially when we're talking about if you're starting to see this preference for European bonds, at least. This seems to be the narrative this morning, over U.S. Treasuries. Is that a capital flow story, then, that doesn't coming into Europe? Where does the currency story show up? To me, it feels more of what are the other asset classes doing to create the conditions for a bid into Europe?
It's interesting what assumptions you make around political risk and the rise of populist parties and whether there's a link between the two and fiscal risk. It's interesting the assumptions you make on that when you talk about preference for Europe versus Treasuries, because, you know, there's political risk in plenty of places right now. We're seeing it play out in France right now. We'll see it play out in the United States later on this year.
Let me go back to the macro story as well. When you think about what is happening, central banks are taking a risk going in front of the Fed. I don't think it's been a big risk yet, but if it continues, does that attract flows into the United States, which ultimately benefits equity markets over in the United States more maybe than Europe? Markets are open here in Europe. Here we go. Again, I struggle to apply a narrative to the session. The FTSE 100 is rising a little bit this morning. I think we're expecting, 0.3% to the upside in terms of well, Anna, we get a woohoo from Anna. It's a very sort of diluted woohoo.
Yes.
Though, I think
It was a slightly ironic woohoo.
I think probably
a cautionary woohoo, if we will. Fairly broadly in the green, which just I think signifies that kind of buyback or a bounce back that we were talking about initially. Guy doesn't find a narrative, but I've got to say one of the smartest people I know at Bloomberg, Cameron Kreis, who's the author of the Macro Man column, once told me sometimes traders trade because they trade, and I think that's the narrative for this morning.
There you go.
Yeah. And it's funny how journalists sometimes apply narratives that the market just is slightly scratching its head about. Nice to see a narrative.
We try.
We've always got to apply a narrative to what is happening here. Here you go. There you go. Market's up by 0.3%. Let's call it 0.4% to really kind of push the woohoo as far as it'll go this morning. Banks are not bouncing back. Banks are up by 0.1% this morning. That is maybe one of the big takeaways from today. But technology's not rising. We've got very few stocks in negative territory. Very few sectors in negative territory. Telecoms are down. Travel and leisure is absolutely flat as we speak. I think the market's kind of digesting yesterday and bracing for tomorrow.
Yes, I'm just looking at where we are on commodity prices this morning, because I see basic resources is one of those only sectors that you mentioned in negative territory. We did have a bit of weakness overnight, I think, in copper prices, and I see that Rio Tinto is one of the stocks that's a little weighed down.
One of the stories that's kind of passed us by, I think, as we focused on the politics over the last few days, has been this bounce we've seen in oil prices, which I think is something you need to factor back into your thinking when you think about what is going to happen with inflation. There was this expectation as oil prices started to track lower that maybe that was going to augment the disinflationary trend. That has now reversed reasonably significantly. So I think it's interesting now that we do see that.
Yeah.
And commodity prices are reasonably stable. So you're not going to get that kind of inflationary help coming, or disinflationary help coming there.
Yeah, crude really rallied yesterday, didn't it?
Yeah.
As traders, according to colleagues, were buying the dip after the biggest weekly loss since early May, following that OPEC Plus report. I remember it took a while for markets to get on board with that bearish interpretation post-OPEC Plus. They did very much get on board with that last week, and then we saw a bit of a bounce back in oil prices yesterday. Kind of holding steady this morning, down 0.1%, but 81.53. So once again, that's our Brent price, of course. So 81.53 is where we trade on the Brent price this morning.
So I want to have a look at Atos and see how it's trading this morning. If it's trading this morning, I wait. There we go. We're positive, up by 1.8%. It's popping around a little bit all over the place. Atos, a positive response to the restructuring news that we've had out this morning. Now it's up by 3.5%. So there's a little bit of volatility in the Atos share price this morning.
There is, and there's two other stocks I'd like to mention. SocGen is one of them, where, of course, in terms of the kind of the bounce back as well. But the reason I bring extra attention to SocGen is because overnight some reports coming out that they weren't able to agree with State Street on a price for their custody unit. So we're going to be wandering some of those negotiations. And speaking of negotiations as well, one of the downside movers catching my eye is AP Moller-Maersk. It's coming after dock workers over in Boston and Houston, halting some of those labor talks. So it kind of feels like some of the narrative there is feeding back into the share price. So a couple of stocks to watch on that front.
France isn't bouncing back that much this morning, though, is it?
No.
We're up by 0.4%.
Kind of on a par with the FTSE.
Yeah. It doesn't feel like this is a convincing bounce back.
No. A cautionary woohoo for sure when it comes to the bounce back. But I wonder if that's just a matter of kind of getting your feet wet a little bit when it comes to the broader trade.
Let's talk a bit about what we talked about yesterday. Chris Watling joined us from Longview Economics. Let's listen to what he had to say.
The growth comes because of expanding banks' balance sheets and more credit, then governments get money anyway. They don't need to do that. We're so lost in this 15 years of dreadful, dire growth. I think governments, you're right about buckets, but if the whole pie's expanding, it doesn't matter. The markets have got a lot of momentum in big-cap tech, so you've got to time the turn. But
you'd buy the European dip this morning?
I mean, it depends on if you're a long-term investor, absolutely. Buy Europe all year this year.
Buy Europe all year this year. Chris Watling, CEO and Chief Market Strategist of Longview Economics yesterday, joining the team. Ewan Monroe, CEO at Newton Investment Management, joins us now. Let's get his take on that. Buy Europe, you a big fan of the Buy Europe trade?
Well, I mean, obviously it's adjusting to the renewed uncertainty to the election in France that wasn't expected. So whenever you get a sort of new factor thrown into markets, they make an adjustment. That's what we've seen. I don't know if it's as simple as just geography. I mean, I think there's definitely been huge leadership by US tech companies, and I think we all look at the valuations and wonder, are they sustainable? And a big part of that narrative of why they're so expensive is the growth of artificial intelligence and cloud. But the the story that they're telling is that that's going to impact every sector, bringing efficiencies and improving profitability. So looking broader and saying who will actually win from utilising AI, not selling it to everybody else, does bring you to Europe, does bring you to some other geographies. So I do think we'll see a broadening out of I think we're starting to see a broadening out of...
Do you have to see a broadening out for this equity rally to continue?
I think you do, because the whole narrative of the tech giants is that everybody's going to be using this technology. They're going to be prepared to spend money on it because it's going to help them improve margins, efficiency, etc. So if that doesn't happen, they're too expensive, and they're going to fall back. If it does happen, then maybe we'll start seeing other winners emerge.
Ewan, it feels like in the last couple of days especially, we've been talking a lot about public finances in a way that markets haven't been as sensitive to, I want to say, in the last couple of months, really until the third quarter of 2023, when, of course, we had that sell-off on the long end. How do you price that?
Yeah, I mean, I think markets are sensitive to it. I mean, you know, it's been this year we've seen, you know, the market pricing out a whole load of interest rate cuts in the US. I think now people feel there's maybe only going to be one this year. And where you've got an economy in the US where they're effectively, you know, spending money, 6% deficit at a time when, you know, borrowing $1 trillion every 100 days. Yeah. And then also, you know, have quite tight monetary policy in a sense. Those two counteract each other, and the market's recognising that by just refusing to let treasuries rally to any extent. So I think there is a recognition, and so I think probably the market's broadly got it right. Post the US election, I think they have to do something about the borrowing situation. I don't think it's sustainable. I think, yeah.
What's the doomsday? I mean, truly, what is the worst that can happen if January 2025 rolls around, they hit the debt ceiling? What do markets do?
Well, I mean, the situation at the minute is they're having to attract borrowing from foreigners. So the US takes in, you know, it's got a sort of international trade sort of funding imbalance, and so there's this $1 trillion every 100 days that has to come from foreigners essentially to fund them. At some point, if that gets rejected, you're going to see something like a UK crisis that we saw with the Truss government, where, you know, we get a rapid move in bond rates, a failed auction or rejection, and that will be bad across. You'll see a strong correlation between equities and bonds in that sort of scenario.
Ewan, thinking about, I mean, you referenced the UK there, so let's go to the UK conversation. I was reading the Markets Live team here at Bloomberg has done a survey of their readership, and it suggests that the readership there says a big majority for the Labour Party, and obviously the polls tell us that the Labour Party could win in the election on July 4th. If we get a big majority, then that would be good for stocks, according to this survey. What is the relationship, do you think, between the size of a mandate that we get for a political party and what stocks will do? Because I'm thinking in other geographies, other times, I've heard conversations that say, you know, gridlock's actually good for stocks. And now we seem to be running with a narrative that a big mandate is good for stocks. It seems easy to argue in a number of different directions. Yeah, I think it depends on the nature of the mandate. So I think the mandate that Keir Starmer is asking for is essentially a mandate to do very little. So he's very, very scared to rock the boat. He's not going to, you know, put up taxes, etc. So there's all these commitments. So I think when you have a large majority on a relatively safe-sounding mandate, the markets aren't going to get too excited about that. I think it would have been very different if, you know, there was going to be a huge majority for the Jeremy Corbyn mandate. Clearly, that would have had a much bigger impact on markets than what we're facing at the moment. Yeah, and we're in a week where we're going to get a lot of manifestos coming through. We've already seen the Liberal Democrats one. We're going to get the Conservative Party manifesto soon. I mean, for an investor, what are the things that you're going to be crucially looking for, either in terms of what it does to the UK economy, what it does to UK risk assets, or what it does to the financial services sector? What are you going to be watching for? Well, I think obviously procurally, I think you know, I would want a government that's supportive of the City of London and financial services. I think that was something that was largely forgotten during the Brexit era, and it is a really important industry for the UK. And so I would want to see that there was strong support, and all the noises off are indicating that there is going to be that support. More generally for the economy, I think we need to see some, you know, serious investment in our infrastructure.
And I think there hasn't been that clarity in politicians' discourse about borrowing between what are you doing to borrow to pay, benefits and so on, and ongoing costs like the NHS, and what are you borrowing to actually build productive infrastructure into the economy. And the two have very different long-term effects. So I would like to see a government that was bold about infrastructure for the UK.
It sounds like you don't think you need to hedge political risk in the UK because you don't think that any of the parties are sounding that bold in terms of what they're suggesting. But broadly around the world, we are seeing political risk causing problems for markets. I look at South Africa, India, obviously the dip there bought, but nevertheless significant volatility. We're building up to the main event, which is going to be the US later on this year, but we've now got a French election to throw into the mix as well. How do you, in your portfolios, think about how to hedge that risk?
Yeah, well, I think we have to build diversified portfolios all the time.
But diversity is underperforming. Your point about tech, diversified portfolios are massively underperforming. So what do you do?
Yeah, well, I agree, but I think the responsibility of an active manager is not to be too short-term. It's to look through. And it can be tough at times because I think you're right. Portfolios that are highly concentrated on a small number of stocks have over-delivered over the last little while. I don't necessarily think that's a responsible position for people to be holding. So I think we have to risk a bit of underperformance in order to get proper diversification.
And when you're thinking about where you diversify, and let's take the long view on markets, I take from your notes that you provided before the conversation, you don't think we go back to rates that are like the rates of the post-GFC inflation. Maybe does inflation not even revert to levels that we saw then when inflation was low? What are your expectations for the rates environment from here?
Yeah, I think rates will gradually drift down, but there'll be nothing like back to the levels that we saw in the 10 years after the global financial crisis. And so I don't think we're going to get a big interest rate declining surge for risk assets. I don't think they're going to be particularly helpful, which, again, what I say most times I'm here in other forums, is we're going to have to get used to making money the old-fashioned way, which is compounding over time.
It throws out opportunities as well as providing risk.
It does. And so there are really attractive markets. The UK isn't the only market that's talking about stock market reform. We've seen that in Japan. We've seen it. I was recently in Korea. There's a value-up initiative there. And so I think sort of looking a bit broader about where the opportunities might be and investing in companies that don't have too stretching valuations is the best way to survive this period.
Ewan, thanks very much. Thanks for joining us. Ewan Monroe, the CEO of Newton Investment Management.
Core 6 looks like this. These are the core stocks around Europe. These are the kind of stocks that really make a difference in terms of their weightings across the continent. You can see broadly a little higher this morning, not by a lot, but a little higher. Nestle, interestingly enough, the more defensive end of that group, certainly a little softer this morning, but broadly elsewhere we are seeing some strength. Let's talk a little bit about Atos. Atos initially went up. Now it's gone down really sharply. In fact, it's just been halted. Let's get some details here. Joe Easton, what do you got?
So as you say, Guy, Atos did rise at the open, but we're now seeing a massive drop, down 10% in a trading halt, as you say. Now, the company has agreed to a takeover from OnePoint, another software company. But as part of that deal, 2.9 billion euros worth of debt will be converted into stock. I've just read a note from a bank called CIC over in France, and they say that this does mean heavy dilution for existing investors, and as a result, it is being taken negatively. As we can see, a nice big round, down 10% on the screen there in a trading halt. We'll keep an eye on where that moves when it reopens in Paris, but it's the dilution of existing shareholders that's the concern for that one at the moment. Then we'll take a look at miners. A 4% drop in iron ore futures at the open of trading. That caught my eye earlier today, and we're seeing a read-through into the mining stocks. Rio Tinto, Anglo, Glencore, Anto, all in London and all down. Rio down pretty sharply, down 2.2% this morning, affected by that drop in iron ore. That's being pointed on the Chinese property market once again. Concerns around that. There was a long weekend holiday there, and that is hitting the market as it reopens on that market as well. I think we're going to look at France because we did have all that focus yesterday. We were expecting some rebounds, but we're only seeing Edenred is a company that does food vouchers and employee vouchers exposed to government contracts. That is rebounding, but the rest of them can't catch a break. The ones exposed to government contracts, Airport de Paris, Vinci as well, the airport operator, SocGen, the banks, still declining. That legislative election weighing on the macro outlook for France at the moment. Then, speaking of macro outlooks, we'll look at UK home builders because they are rallying following that UK wage data. It is easing. Now, we will get a Bank of England rate decision next week, but the day before we'll also get CPI from the UK, so there's still a lot to play for. But wages easing ahead of the Bank of England is positive for home builders. Bellway, Crest, Persimmon and Taylor Wimpey, all of them seeing decent gains this morning. Then another one in the UK, another sector to look at is the staffing firms, because Exane BNP Paribas is calling the bottom of this market. They say that the staffing companies have underperformed more than they did during the financial crisis in this economic downturn. They say it's gone too far, and those companies like Page Group should be getting a boost. They upgrade that one to outperform and getting a nice rise, up 1.8%. Finally, another broker move, this time in tech. BE Semi, the rival to ASML, the chip manufacturing company, the semiconductor industries firm. That one's upgraded. This one is over at Redburn. They go buy on that one. Actually, the price target below where it's trading now, but nonetheless, gaining 3%. Positive sales update from them last week. That one is gaining in Amsterdam today.
Joe, thanks very much. Joe Easton from our equities team with a rundown of some of the stocks on the move. He's right to point out Basic Resources and the underperformance there. That one of the few sectors moving decisively this morning. That's down by 1.5% for the mining sector in this morning's session. Talking of decisive, we see the Bank of France's Villeroy saying the ECB rate cut marks a decisive orientation. This in the context of Christine Lagarde giving a slightly more measured language around what that cut that we saw last week means for the future of rate policy.
It's interesting that you mentioned that, because I was just looking at the bond market as well. You are seeing a bid into every single bond market in Europe, except for France, selling off by about 5 basis points this morning.
Citi's out with a note this morning talking about the fact you don't want to buy French debt until you see the Bund OAT spread going to 65 bips. We're at 55 now. There's some action, therefore, still to come, potentially in the widening. Yeah. Basically, the expectation would be that a Le Pen-led government would basically spend more.
Yeah, and Deutsche Bank actually coming out as well and saying 40 basis points instead of 65 on that. And actually saying what I thought was interesting with that report, that the rating downgrade doesn't reflect the twin deficit. They're actually saying it's worse than the rating downgrade suggests.
Yeah, it's interesting that some of the comments we've been having about preference for European government bonds don't seem to place too much concern on that. You know, would a government run by Marine Le Pen, would it spend more? And others do. Others say that's decisive.
There is this huge argument, though, which Europe is still grappling with, which is, do you spend more money and actually get a better result? Look at the United States. Why is the US economy outperforming? Now, there's kind of structural reasons for it, but there's also the reason that the government is spending money like it's going out of fashion.
And in a very different geography, Ewan Munro talking to us about how in the UK he wants to see investment in infrastructure, drawing that distinction that's been, drawn, age-old distinction in financial markets between borrowing to invest and borrowing to fund the day-to-day, which sometimes gets so confused in the politics.
Yeah, which comes back to the point that you made, I want to say a couple months ago, about the fiscal spend in Spain and Italy as well, in terms of the outperformance that you're seeing. Italy, again, winning that case.
Yeah, the peripherals that were so underappreciated now maybe becoming a little bit more appreciated.
We need a different story, or we have a different story this time around, don't we? It's certainly not 2011. Coming up on the programme, Apple debuts its long-awaited new AI tools. We'll get a rundown of what we heard from Apple, what the relationship with OpenAI is going to look like, and we'll get Musk's response as well. This is Bloomberg.
Recent developments in generative intelligence and large language models offer powerful capabilities that provide the opportunity to take the experience of using Apple products to new heights. Introducing Apple Intelligence, the new personal intelligence system that makes your most personal products even more useful and delightful.
That was Apple CEO Tim Cook on introducing Apple Intelligence at their developers conference. Apple has unveiled its long-awaited suite of new AI features, including a partnership with OpenAI, the maker of ChatGPT. The iPhone maker is betting that a personalized and understated approach to the technology will win over customers. It's a high-stakes bid to catch up with rivals in the booming AI market. So what did we make of it all? Let's talk to Matt Bloxham from Bloomberg Intelligence, who's been looking at the detail for us. Matt, good morning. So did the event do enough to boost sentiment in Apple's growth outlook? I mean, the stock, we were talking in the break, the stock sold off a little, a couple of percent, but it's been up a lot year to date. So what did we think it told us?
Yeah, that's right. I mean, I guess from about April, it's up almost 20%. So I think the market already moved in anticipation of this event. And I think it's betting to a degree that this is going to drive some kind of smartphone upgrade super cycle from September when the iPhone 16 comes out. And that's essentially the first device that's really going to be able to use this. I mean, the iPhone 15 Pro and Pro Max are capable, but that's only on the current lineup. So I think there was a lot there, a lot to digest. It's a very slick, comprehensive set of tools and applications. It's going to enhance everything you do in the Apple environment: email, messaging, notes, all of it. But yeah, I think there was nothing there that wasn't very well flagged into the event. So there was no kind of incremental, wow, I didn't see this coming. That's kind of really added to our conviction. I mean, the market's expecting iPhone sales to grow about 6% next year. So there's an anticipation that from this kind of prolonged dip in iPhone sales, this is going to drive some kind of recovery. But I'm sure over the next few months, there's going to be lots of kind of swings around, whether this is really going to drive a stronger uptick in iPhone sales.
I'm just happy I'm getting a calculator. Let's talk a little bit about, on my iPad, let's talk a little bit about Musk's reaction, Elon Musk's reaction to this. He's talking about banning Apple products. He's concerned about the integration of ChatGPT into the software. Is that a legitimate concern, or is that the ongoing spat that he's basically having with Sam Altman and OpenAI?
Yeah, I mean, I think there's definitely a healthy dose of that. At least that would be my perception, because as you say, there's a long-running feud there. And obviously, Elon Musk is developing his own alternative to that platform. And this is obviously an opportune moment to kind of get some spotlight with Apple talking about this stuff. I mean, I think there clearly are legitimate concerns around, the safety of generative AI in general, and also the amount of data you're sharing as a user when you make a request of any generative AI platform, whether it's ChatGPT or anything else. And obviously, Apple's trying to kind of mitigate a lot of that. They went to great length just to say most of what you'll do as a user will be on device. And when it goes onto the cloud, they've got this new private cloud environment. And I think they'll take that into the ChatGPT relationship too, saying that your IP address will be masked and ChatGPT won't hold on to the request you make. So some specific privacy issues that Apple has set up there to kind of mitigate some of these concerns.
All right, Matt Bloxham from Bloomberg Intelligence, we thank you so much for joining the program, breaking some of that for us. And speaking of breaking down some of the tech story, we're getting some headlines coming out of China's foreign ministry. The EU's probe into EVs is trade protectionism, they say, saying there's no solid grounds for the accusations, and they won't sit idly by if the EU takes action on EVs. I believe we are expected to hear from them later this week in terms of the provisional conclusion of the EU probe. Coming up on the program, we can go right back to the markets. One of the world's largest market makers is entering the European rates market. We're going to have an exclusive conversation up ahead with the global head of rates trading over at Citadel Securities. Michael DePass joins us to talk about how to play this market in both sides of the Atlantic. What deficit concerns do we have? What does the market plumbing look like? Liquidity, all that nerdy stuff and more coming up ahead. Stick with us. This is Bloomberg.
I think in terms of an attraction, German 10-year bunds and French oats, the 10-year there, their spreads have narrowed significantly in the past month or two relative to treasuries, and today as well by 8 or 10 basis points. So there's coming a point where European bonds are more attractive than treasury bonds, in my opinion.
PIMCO co-founder Bill Gross there, echoing an opinion that we started to hear a lot this morning, where perhaps, especially in the context of the sell-off we saw in European debt off of the EU parliamentary elections, they may actually be a little bit more attractive relative to the Treasury market. One of the largest market makers in the world, in the meantime, entering that European rates market, Citadel Securities, planning to challenge the dominance of investment banks in the 10 trillion euro market. Joining us now for an exclusive conversation, I'm pleased to say, is Michael DePass, Global Head of Rates Trading over at Citadel Securities. Welcome to London. Thrilled to have you here.
Thanks for having me.
We'll talk about the business in a moment, but let's talk about these markets first. This is interesting that we're on both sides of the Atlantic. We're talking about deficit concerns, public finances. Of course, we know that the fiscal deficit in the U.S. is a looming issue on politics, on the election. It's a similar story here in Europe. How do you play it? How do you invest in that?
Yeah, so and it's a question that obviously a lot of our clients and a lot of our investors have been asking, and there is some concern around the growth and the speed of the growth in deficits that we've seen globally. But you know, investors continue to find value in bonds, particularly at these yield levels. We continue to see interest in both in U.S. debt, and our conversations as well point to significant interest in European debt. From the clients that we speak with. And I think that really highlights for us the focus and the reason why we're looking at getting involved in the European market is that it is a big draw for a number of investors, and there is real interest from our investor base for us to bring the kind of liquidity that we brought to the U.S. market over to the European markets.
I'm glad you brought up the liquidity story, because that's one of the concerns of why people, one, go to the U.S. Treasury market in the first place and why they don't go to Europe in the second place. Talk to us about why that's even an attractive proposition at the moment when, again, we're talking about real weakness on this continent.
Well, for us, the idea is how do we bring liquidity to that market, right? How do we aid the market structure? How do we aid the market resiliency? And I think it's important to recognize that the European market has functioned quite well over the last few years, right? We've went through a very aggressive hiking cycle, and the market had no functioning issues. So for us, it's about how can we bring a differentiated type of liquidity, a tech-focused liquidity, to a market that maybe hasn't had that approach before.
And so you're expanding into European rates, Michael, which is really interesting. And you're doing some of that in Paris, I think. Talk to us about that Paris hub. It seems to be attracting, well, it's attracted you, it's attracted others, and some people draw a link with Brexit. But you tell me about what attracts you to Paris. Yeah, so we're quite excited about our Paris office. We're going to be running our European rates trading operation and sales operation out of Paris. And it's a fantastic talent pool, a very technical talent pool, and we've been able to find resources, whether it's across sales, trading, or technology, that really quite additive to our business. That's interesting. I was going to ask, are you having to take talent from London to Paris? But no, doesn't sound like it on a big scale. We've made a few hires from London as well, but Paris in of itself is a quite deep talent pool. And what are the plans around gilts? So right now, we've done our first trade in sterling IRS. We'll be fully live in that space over the next month or so. And then I think if your ambition is to be relevant and a material player in the space, which for us it is, it's inevitable that you trade gilts. So get sterling IRS up and running, and then focus on gilts.
I think European politics, we're seeing a lot of volatility at the moment. Do you think it changes the attitude of businesses like you to where you do business in Europe, the types of governments that we're potentially going to be seeing formed? There's been a lot of... The Macron government has made a big push to attract a lot of people into Paris. There's a bit of volatility in French politics right now.
Yeah, the one thing I would say is that the European Union overall seems to be quite focused on its capital markets, right? So we're seeing a revitalization of a true capital markets union, a focus on making markets more efficient, a focus on improving liquidity, improving transparency. And I think politics are always a feature of markets and always something that have to be navigated. But certainly the underpinnings of the European Union, the underpinnings of the European financial system are quite strong.
Politics is starting to insert itself in a way that it hasn't until recently. You're seeing it with what we've seen in European government bonds, OATs, yesterday. The gilt market probably is feeling a little bit more kind of comfortable with what is happening on the political front over here, but we've seen emerging market politics kind of upending markets in quite a significant way. We're all kind of building up to November, though. we're all trying to figure out kind of how markets are going to react and price in what we see in terms of US politics. Is that a conversation you're having now? Is that a trade that you would think about putting on now? Steepeners are super popular now, but they're not taking off. Is that a trade that takes off after the election? I'm wondering whether this is something that you are actively pursuing at the moment, or is it something that you wait until September, October before you start putting those trades on?
Yeah, I think you bring up an interesting point about the curve and the level of inversion that we've had for some time. I do think, even if you take politics aside, if you look at the setup in the economy now, you have inflation that continues to run above target. And we think that we have a Fed that's going to be very responsive to any weakening in the labor market. Those two things together, independent of politics, we think favor more term premium, favor a steeper curve. So maybe the political dynamic adds an additional tailwind, but separate from it, the macro setup for it does seem positive.
Are there liquidity concerns in the U.S. bond market right now, given the auction narrative that we're talking about, perhaps less demand coming out of China, Japan, et cetera, married with the fear of that kind of debt ceiling in January 2025? How liquid is the most liquid market in the world?
At the moment, it's quite liquid.
Too liquid?
And I would say I don't think a market can be too liquid. I would say that we see significant foreign demand still for the U.S. Treasury market. That continues to be an important story and an important source of demand. And when we look at it, there are, of course, some concerns that exist in the market, but there has been a number of efforts. Well, I think to your point, can supply overwhelm the market? Are there issues with liquidity? But we've seen a number of steps being taken to improve market functioning. So a focus on an increase in transparency, a focus on an increase in central clearing. These things are all very good for market structure and really aid the functioning of the market over the longer term.
Michael, can't let you go without asking you about the very near term and markets and conversations with clients, what they're focused on. Clearly, we get data out of the US on CPI tomorrow. We get the FOMC decision, and some people are predicting we could see volatility in all kinds of markets as a result of those two things coming so closely together. What are conversations with clients like around that subject?
Yeah, so I think when we look at the inflation data in particular, there's a feeling that the volatility around those prints going forward is maybe going to come down. I think for tomorrow, the focus really will be on the FOMC, and in particular, what does the dot plot show for the number of expected cuts for the rest of this year? That number has obviously come down materially over the course of this year, and the market's split between, I think, somewhere between 1 and 2 cuts. So there'll be a little bit of a reaction, whatever the outcome.
How big a pinch of salt would you take when it comes to the 25 dots? The Fed's, all of our predicting capabilities have been severely tested this year.
I think you take a very big pinch of salt with anything relating to 2025 predictions. The data has confounded many people. The cycle has not evolved the way we would have thought. Yeah. It's a very different cycle than what we're used to. And I think the market recognizes that if we're talking about the 25 dot, for example, it's so data dependent. There's so much evolution that can happen to that prediction over time that it's weighted certainly less, I think, than it would have been in the past.
In terms of, so how are you thinking about the kind of the way that the arithmetic works? If we get 2 this year, do I assume that I'm getting a cycle, or is this just a mid-cycle kind of adjustment? Do I assume that I'm going into a full-blown kind of cutting cycle here, and there are going to be more that follow? Essentially, this is the debate that we're having at the ECB right now, and I'm just, what is your kind of current thinking about how many we get in total? Is it a cycle? Yeah. What makes a cycle?
Yeah. Well, the ECB made sure to stress that it wasn't the beginning of an easing cycle. They clearly want to retain optionality, and I think that's going to be the major theme out of central banks, is that we will adjust, we will respond to the data, but we want to maintain optionality. We don't want the market to get ahead of us. We don't want the market to maybe ease financial conditions in a way that's not really beneficial. So I suspect that we're never say never, but it's going to be difficult to get back to the zero lower bound. I don't think that's where we end up this cycle. I think we're talking about a cycle that ultimately looks like 200 basis points worth of worth of easing, and probably a bit more spread out than what we've been used to over the last 10 or 15 years.
A final question to you on the reason you're in town, of course, and that is that expansion into Europe. One of the things I've noticed in this part of the world during my time here is that there is a delay in terms of cross-border transactions. Things aren't cleared as quickly as they are in the American markets. How long before some of those cross-border transactions that even politicians across Europe are trying to make work faster gets to the level that Citadel has created in the States?
Yeah, and I think that's a good point that you raise, and one of the main impetuses for us getting into this market is obviously providing liquidity to our clients, improving their day-to-day experience, but also where we can to push market efficiency and to push the market in a way that's beneficial for all those involved. So that's what we're focused on, and that's what we're focused on delivering.
Do you have a timeline for that?
No timeline. I think head down, get to work, and see where we end up.
All right. Well, we will, of course, love to have you back and get that update on how that's going. Michael DePaz, a pleasure to have you on the program. Global Head of Rates Trading at Citadel Securities, Guy.
That's a good attitude. OK, coming up, UK unemployment hitting its highest since 2021. Muted reaction in the pound. Some softening, but we are way away from the kind of levels you need to see, particularly on wages that are consistent with a 2% inflation target. We'll talk more about this next. This is Bloomberg.
Welcome back. This is Markets Today, 8:45 here in London. We are 45 minutes into a European trading day that rebounds a little from yesterday. Certainly in the Paris market, we're up by 0.4%. And that is now, after a slow start, outperforming the rest of the European story. But the rest of the European story is sluggish, up 0.1% only on Stock 600. US futures more muted as we wait for plenty of data out of the US and an FOMC decision. We've had data out of the UK already this morning. UK unemployment unexpectedly rose to the highest since 2021. That's while private sector wage growth cooled to the lowest in 2 years. The figures show the labour market is slowing down, but it is unlikely to be enough to persuade the Bank of England to begin cutting interest rates at next week's meeting. Of course, the politics might play in there as well. Let's talk to Sandra Horsfield, senior economist at Investec, who's with us now. Sandra, on first glance, it seemed possible to draw sort of mixed conclusions from the labour market data out this morning. But, you know, diving deeper, maybe there are reasons for the Bank of England to feel reassured and that we're getting closer to the point where they can cut interest rates, but maybe the politics gets in the way. Your initial response to the data we had out this morning?
It's certainly heading in the right direction. Yes, there are more...
Oh, sorry, I missed that. You said they're heading in the right direction. Oh, OK.
She doesn't look like she's moving.
No, she doesn't, does she? OK,
we're going to get her back.
Sandra Horsfield.
It
there
says
you go.
so on the screen, yes. Apologies to Sandra if you can hear us. We can't hear you. Your picture froze, so we're just going to try and reinstate that picture. But you made the point going to break, Guy, about where we are on the inflation story, where we are on the wages story. In fact, that the wages... They're too high to give us 2% inflation. Is that the conclusion we got from Dan Hansen?
You are at kind of circa 6% right now. You need to be at circa 3% in order to make the 2% inflation target. We are miles away from that. But the trend broadly appears to be in the right direction. The unemployment data, broadly the inflation data, I think here Sorry, the labour market data here is something that I think the market does seem to be slightly sceptical of as well. The return rate we're getting in terms of the data, the surveys that are being done to get this data, are relatively poor at the moment. And the labour market data continues to be really difficult to, I think, interpret here in the UK, which is why maybe actually the Bank of England has placed a much greater emphasis on what it's seeing in the service side of the economy. So the service sector data is really where we appear to have kind of put most of our attention, certainly from a Bank of England point of view. Let's try that again, shall we? Sandra Horsfield, senior economist at Investec, I think joins us now. And let's hope this time it works. Signs aren't good.
No,
I think we're not going to do this again until we've definitely guaranteed that this is going to work. So let's carry on with the conversation.
It's been a good 1 hour and 48 minutes of the show anyway.
We were pressing our luck.
gone to pot. Yeah. But yeah, thinking about where the Bank of England goes from here, then Kriti, and of course the politics has got in the way. They put themselves into a sort of self-imposed purdah. So we haven't heard very much from the Bank of England and what they're thinking about any of this data, and we're not going to, because of course, even in the wake of, we are going to get a rate decision, but then we don't get the election until July 4th.
Yeah, and you know what I thought was super interesting? Anna Andrade of Bloomberg Economics talks time and time again, I think every time she covers any economic data point, is that the BOE is far more reactive than some of its other central banking peers around the world. But you're not actually seeing that show up in the markets, for example. I think this is the biggest slide I've seen on a UK data point that's actually stuck when you look at cable. 127.19 right now on that currency pair. It kind of feels like the sensitivity is kicking in, but I'm curious how that changes going into the CPI next week.
Yep. I think the sensitivity... To Anna's point, it's really difficult to judge kind of how sensitive the Bank of England is right now. Because also, there are different views on the MPC, which you are getting those different views manifesting themselves in a way that we're not seeing on other central banks. I think the Bank of England is really hard to call. Is it August? Is it September? Kind of how does the data evolve between now and then? How does the politics evolve between now and then? We're also not going to get a fiscal event probably for quite some time, so that's going to be something else that we need to factor in as well. But it does seem as if the clearest kind of narrative for the UK economy is around services. And that's where they make their kind of make their sort of bed. Let's kind of think also about the fact that the ECB has gone and is now having to, in some ways, be a little bit more cautious, having made that initial rate decision. Yeah. Which I think is a kind of, maybe it's a lesson that the Bank of England is watching quite carefully too.
Yes, I think it's really interesting, the commentary we had out of Christine Lagarde just over the last 24 hours. I mean, it is interesting what she said, but also how widely she said it. So this is an interview that she's given to one European newspaper that seems to have been picked up and published in lots of different European newspapers. This message going far and wide. It's not necessarily the case that they're on a declining linear path and they may need to hold again. And this goes back to that. Yeah, how many rate cuts do we get from the ECB? Is it? I mean, it's, you know, the ECB won't want to think it's one and done necessarily, and we talked at the top of the programme about what a policy mistake looks like. But there isn't the assumption that we've seen in times of crisis that you get cut after cut after cut, month after month, on that kind of cadence.
So you've tried twice. I'm going to have a go now.
Excellent.
Okay.
I'll leave it to you, Guy.
Maybe I'll have slightly better luck.
Third time's a charm.
Sandra Horsfield, can you hear us? That's where I'm going to start. I think that's my first question.
I can indeed.
Excellent.
I can.
Excellent. This is good. We're going to start there. First question, tick in the box. Second question: is today's data consistent with a August rate cut from the Bank of England, a September rate cut from the Bank of England? How does today's data feed into the argument about the timing surrounding that central bank decision?
We think we'll still get there by the time August comes along. What we're seeing is more signs of weakening in the activity metrics of the labour market. In time, you would think this translates itself into weaker wage demands as well. Vacancies are still falling. We are at the highest level in unemployment in 2 years. All of these factors should play a role. It's just not there yet, not enough to really prompt a rate cut just as soon as this month.
In terms of how you are thinking about which data the bank is focusing on, how important is the labour market data? How important is the wage data vis-a-vis certainly what we're seeing with services? How should I weight the relative importance of the data?
I think the wage numbers really are crucial, and that is because wages, of course, a very important input into price pressures, and that's the part where you think what the Bank of England does in terms of its policy rates will have the most direct impact. So what we're seeing now, specifically, it's not the overall wages that matters the most, but the private sector regular pay series is the one that the Bank of England focuses on. And we are seeing progress there. Yes, we did see a decrease in the annual rate there. 5.8% is not yet good enough, for sure, though, if you consider the soft picture that the UK is producing in terms of productivity. We can't afford 5.8% pay growth with the poor productivity growth on a sustained basis. But wage growth is slowing, so perhaps soon we will be in a position to cut rates.
OK, so those kind of wages not sustainable, you think, with that kind of productivity level. What difference does the politics make, Sandra? We are waiting for details, I suppose, from various parties, but the market orthodoxy at this point seems to be that the market isn't too worried about the UK election in the context of other bigger global worries that it might have, other political events markets might be more worried about. What difference will the election make to your thinking around the UK economy?
Well, in this particular instance, for the next meeting, the politics makes a very big difference in that the Bank of England is in a self-imposed purdah period. It's not officially bound by the same rules as other civil servants are, but it is choosing not to speak around the time of the election itself. So to surprise the market with a rate cut right now and not be able to explain it, that seems very unlikely. So we think the chances of an actual rate cut this time around is very slim because of the timing of the election. Now, what happens afterwards? I think if you look at the sort of basic policy premises that are being put out by the Labour Party, but also by the Conservatives, the differences are not actually all that large. We are still very much scarred by the Truss experience and by having to pursue a very tight fiscal backdrop and navigate that without major changes. So all of these factors will play in, but I think the market is quite relaxed because huge unexpected fiscal policy shifts are unlikely whoever ends up taking power.
Sandra, forgive me, this might be a fairly simple question, but what is the bar for the rate hike narrative to seep back into the picture? Just 2 months ago, it felt like really markets on both sides of the Atlantic were considering the possibility of a re-acceleration of inflation narrative. What is that still on the table? What does it take to get there?
I think if we think of what central banks are trying to achieve, there are certainly parts of inflation that are completely outside of their control. Energy prices, obviously the global economic backdrop is very much influenced by factors such as these. But there are parts that they can affect, and the important part they're trying to affect are inflation expectations. And if you look at those, there has been signs of progress. It has been very encouraging that the high inflation episode hasn't really destabilized inflation expectations on a very sustained basis. We're seeing declines in inflation expectations. That means central banks can, in a forward-looking sense, reduce their policy rates, not because the economy is falling off a cliff, but because if we have low inflation expectations, simply keeping rates where they are would make policy more and more restrictive. And that becomes unnecessary when inflation is heading lower. So we're in a very fortunate position of being able to lower interest rates to respond to an easing in inflation expectations. And that's the Goldilocks path that we had all been seeking. Now, exactly how quickly we get there, that is a different matter.
Yep.
And that's perhaps
Sandra,
not quite so imminent.
Sandra, great stuff. Thank you very much indeed for bearing with us. We greatly appreciate it. Sandra Horsfield, Senior Economist at Investec. Thank you very much indeed. Quick run through what we're expecting for the rest of the day. There's an auction, there's a Ukraine recovery meeting, which we want to keep an eye on. OPEC monthly oil report. Oracle earnings are out a little bit later on. A bunch of ECB policymakers are going to be speaking as well. But I think what we're really waiting for is CPI out of the United States tomorrow. And the Fed meeting.
Yeah, just the small matter of the Fed meeting and a US CPI. Yep. It feels like the whole month's been condensed into a day.
The cool kids are calling it a double whammy.
Is that what the cool kids are calling it?
The cool kids are. You clearly did it. I'm informing.
I'm so glad
informing the crew.
What the cool kids say.
Just letting you all know. We'll see how that shows up. That does it for markets today. The Pulse is up next. This is Bloomberg.